Good afternoon, everybody, and thank you for attending today. My name's Tom Zano, and I'd like to welcome you to Zano Hall and Farron's Lunch with ZHF as we present the topic, Ohio Department of Taxation reverses course on business income, how CPAs and tax planners can respond. I'd like to, before we begin the program, just provide you guys a little bit of a background here and a notice. I need all the participants to understand that the information that our firm and the other participants are going to be providing today are general information and only general guidance. It is not legal advice or accounting advice. There's no substitute for consulting with professional tax or accounting folks and looking at the actual facts and circumstances and, of course, the related law when it comes to any particular matter. I also want to point out that today's presentation could be considered advertising material under the Ohio Attorney's Code of Professional Conduct. So just putting everyone on notice of that. But I think we're going to have a great program today. I'd like to introduce the panelists. And as my mom always taught me, ladies first. We will start with Deb McGraw. Deb is a partner at Zano Hall and Farron. She's been with us from the beginning. And she also, in her prior life, was at PricewaterhouseCoopers and Coopers and Lybrand as well. Also want to welcome Ted Bernard, who is a partner with Baker and Hostetler. Ted is a longtime state and local tax practitioner and has been around a long time, has been a colleague of ours for many, many years, and we are so glad to have him participate with us today. I'd also like to introduce from Baker Hostetler, David Ebersol, who's an associate with them and also focuses in on state and local taxes. And he also had, before outside practicing law, he was an attorney with the Attorney General's tax section in Ohio. Also with us today from the Ohio Society of CPAs is Greg Saul. Greg serves as Director of Tax Policy and works with CPAs on a lot of these issues, and we appreciate his participation, as well as, of course, myself will be serving as a little bit of a moderator today and also going through some of the slides with you. Before we dive in with the background on the bid, I want to just go through quickly what the agenda will be. So we're going to talk today about a topic that has been impacting our practice almost continuously since July. And it started really well before that, but after the Department of Tax kind of got back to work post-COVID pandemic adjustment, we've really seen a pickup in the activity in this particular audit area. We think that this is not only impacting our firm and what we do, and of course what Ted and Dave do, but it's also impacting CPAs and tax preparers, tax planners, and most particularly business owners. And so we think this is a great program. It's also an important program to do here at the very end of the year because there may be some things we want to do as we approach year end in order to avoid what we're going to talk about today in terms of some of the views of the Ohio Department of Taxation and how they're applying the law. And all this relates to, of course, the business income deduction. I want to remind the participants that if you'd like to ask a question, we are happy to answer questions throughout any time in the program today. There is a chat function, and please, if you enter the question in the chat function, we will be sure to try and address that before the program is over. Also, sometimes when you go to push on the chat, it might say that you need to launch a channel. If you say okay, all that really does is just you have to enter your name or some name. It doesn't have to be your name, but you just enter a name, and then that way you'll have access to the chat function if you're viewing us today on YouTube. With that, what I'd like to do is turn, I want to go through the agenda. So again, we're going to start with a background and the history of the business income deduction. Greg Saul is going to cover that with us and provide, what's going on with the bid. We've known that it's been a little bit controversial and under attack. And then Deb McGraw is going to discuss a recent audit program and a position that the Department of Taxation has taken as it relates to sales of businesses and the capital gain that's associated with such sales and whether or not they qualify for bid treatment. Also, and when I refer to bid, by the way, I don't refer just to the $250,000 deduction, but also the flat rate together with that. Then Ted's going to cover some of the historical treatment of business income in Ohio. That's obviously going to be an important aspect of this. Dave will discuss why the Department of Taxation is wrong, we think, in terms of their position, and discuss the ins and the outs of that. I will then cover some year-end and business sale planning that CPAs and business owners may want to consider. And then finally, Ted and I will touch base on how taxpayers are responding and discuss a client coalition that we're sponsoring together. With that, I would like to turn it over to Greg Saul to give us some background on the bid. Greg.
All right. Thanks, Tom. Thanks for letting me kick this off this afternoon. So I just want to, we can go to the next slide, give a little bit of a legislative background of the bid, and then also kind of some developments over the years since it's been enacted. The bid first came about in 2013, and it's always kind of debated during the budget bill process, and it was in the 2013 budget bill. The deduction amount has always been set at $250,000, but the percentage that you're able to deduct hasn't always been the full 100% of that $250,000. When it was first enacted back in 2013, it was 50% of the first $250,000, and then in 2014 it went to 75%, and there was no flat tax above that. You paid the normal graduated brackets. In the 2015 budget bill, that's when we first saw the 3% flat tax come about. They kept it at 75% in 2015, but then they had that 3% above that. So 2016 tax year was the first tax year that we actually saw the bid as it exists today. 100% of the first $250,000 on the deduction piece, with that 3% flat tax above that. And so now, with our top graduated rate being 4.8%, that you see about a 1.8% cut. A lot of times when I see the newspapers editorialize on this, they're saying businesses get a 40% income tax cut. And that's where they're getting that, because it's the top rate's close to 5%, but they're getting that 3% flat rate. So that's where they're coming up with that 40% cut. And then, it's filed on the at the Department of Tax on the IT BUS form. So go to the next slide now. I was ready for the next slide. Yeah. One of the things I did want to mention, and it's important to point out what Tom said, the deduction piece of it and the 3% flat rate. They overall, it's considered the same tax expenditure in our minds, but when you look at the tax expenditure report that comes out every 2 years with the Department of Tax, they only focus on the deduction piece of that. And so last I looked, it's about $600 million on the actual deduction. And then I believe the 3% flat rate cut brings in about another, $500 million tax benefit to taxpayers. So usually when you see they combine those two amounts, and they'll say that this entire deduction with the 3% flat rate is a little over $1 billion that goes back to taxpayers. So one of the things when the bid was first created, and this was important just because back in 2005, when Ohio enacted the commercial activity tax, it got rid of two taxes that C Corps pay, the tangible personal property tax and the corporate franchise tax. And so C Corps are paying only the CAT now in Ohio, which is good news. But pass-through entities were still paying two taxes, the individual income tax and the CAT. And so this was seen as a way to put pass-through entities on a more equal, at least tax policy-wise, playing field with C Corps, so that they can get that PTE deduction on some, especially the smaller businesses can get that on the first $250,000. And you see that policy also within the CAT itself. The first $150,000 in gross receipts is not taxable, and then up to $1 million, it's a flat $150. And so really encouraged policy to have for small businesses in Ohio. One of the things that they said that they enacted it for was job creation. And you see that a lot as a talking point. Well, how many jobs has it created? it has been hard for us to put an exact number on the number of jobs. But the one thing that I will mention in that area is when we had a survey of our members last year during the budget bill and asked, what are your clients using this for? And if it's not exactly always creating jobs, one of the things they said is, well, it allowed us to do a health insurance program for our employees. It allowed us to set up a 401k program match for our employees. Some of the businesses said that they purchased equipment with that money. And also some of them just said, hey, I was able to give my existing employees a salary increase. And so it is important to point out that this money savings is used for a lot of different purposes by businesses. So, all right, let's go to the next slide. So just over the years, I mean, I know the topic today is sale of a business and the resulting goodwill and capital gains that the department has interpreted that. Those notices went out about a year ago. This isn't the first time that we've had some issues that have come up on interpretation of the bid. Right out of the gate, one of the first ones that I recall that came up was whether or the department actually said you could use the family attribution rules in IRC section 318. And then in 2015, they said that you couldn't use those. And so one of the things is we had a conversation with them, like they had said in multiple presentations, you could use the family attribution rules. And so they ended up allowing it for 2013 and 2014 to get to that 20% ownership threshold. But then starting in 2015, you could not. And so that was addressed directly with the department, no legislation, no litigation. Then the PEO issue came up, professional employer organizations. They were saying that small businesses that utilized PEOs were not eligible for the bid. And so we worked with different groups to get that fixed in Senate Bill 8 last General Assembly. So then businesses that utilized PEOs were able to take advantage of the bid again. And then, the rest of the panelists are going to get into this new issue that has come up on sale of a business and the resulting goodwill capital gains, the audit letters notices that have gone out. So one of the things that I just wanted to mention before I wrap it up here, and we'll go to the next slide on this one. One of the changes last year as the bid was being debated in the legislature, they were looking to pare this back. The House sent the budget bill over to the Senate, reducing the deduction to $100,000, and they were getting rid of the 3% flat tax. As it came out of conference committee, everything was restored, except they were going to exclude lawyers and lobbyists from taking the bid. And so as that process went into the fall, lawyers and lobbyists worked with the House leadership at the time to restore that for everyone. But one of the things that Senate Bill 26 did is the House leadership at the time wanted to start tracking which businesses were utilizing the bid. And so there is a requirement on the form this year when you're filling this out that you have to put the NAICS code of the industry group that you're in on. There's going to be a line on the form. And if you want to take a look, the department has already finalized that rule. The link down there on September 18th. Now, I don't know if this will be here to stay, but it's here at least for this tax year. The department didn't ask for this. The business groups did not ask for this. And so now that there's been a change in House leadership, it's probably going to be the topic of discussions of whether it'll be around in future tax years. So that's kind of the state of where we're at now. And I'll let Deb take it from here. Thank you.
Thanks so much, Greg. I'm Deb McGraw. I'm going to talk about the Ohio Department of Taxation's Capital Gain Audit Program. And as Greg talked about in terms of his mechanics of the bid, the ITBUS is a form that's required to be filled out showing the sources of business income. It also contains the calculation. And so it's this line 3, Schedule D, capital gains and losses. All these schedules reference the corresponding schedule in the federal return, but it's that line 3 that's the focus of the department's audit program. Next slide. There were a couple of notices before this, but in late 2019, early 2020, the Department of Taxation sent out approximately 200 plus letters to taxpayers. It's our understanding, and they've been public about this, that 200 letters represented the largest gains treated as business income on line 3 of that ITBUS, the Schedule D gains. Those letters requested information on the supporting federal schedules, copy of the legal agreement, and a description of why the gain qualified as business income. We believe most of those letters went to Ohio residents. At least that's what we've seen in our experience. But basically, Ohio residents that sold a business and remained in Ohio. Most of the taxpayers or their practitioners responded kind of early to mid last year. As you know, there was a pandemic, and so the department put an administrative hold on a lot of those matters, and that was intended to be a taxpayer-friendly activity on their part. But I think what happened is, as folks came back and the department came back and was full on, there ended up being a flood of variance notices and assessments that were issued, I'd say between August and October of 2020. And so it was a little bit crazy, but we would expect, we haven't heard the department say this, but we would expect they'll send additional letters in the future. A big focus of the ones we saw in August through October was the 2015 calendar year. As Greg mentioned, 2015 was the year you could take the deduction and the lower rate. So that's when the big bucks started to apply. I would expect, because I don't think they covered everything in the intermittent years, 2006 forward as well. They're probably going to want to pick up calendar year 2019. We have seen situations where they got one owner, but they haven't contacted the other owner, even though they may have had similar amounts at issue. Next slide. So why is the department doing this? Why are they looking at these Schedule D gains, and in particular setting their sight on the sale of a business interest? Their view, and Ted is going to talk in more detail, as is Dave Ebersol, but their view is that it's a legal sale of a business interest, and a legal sale of business interest is non-business income. So you don't get the business income deduction, you don't get the lower rate on business income. Typical fact patterns we've seen, and I'm talking about responses to this Schedule D line 3 request. One is just a simple legal sale of assets. So you sold real estate, you had a large capital gain on your Schedule D. Typically, that's a mistake. It's our understanding sale of assets is not supposed to be recharacterized as non-business income, but just know that's out there. There could be some exceptions. More commonly, what we've seen are legal sales of a business interest. So an S Corp stock sale, a membership interest of an LLC, a partnership interest. Sorry, go back a slide, Tom. In particular, in addition to just straight sale of a business interest, I would say a pretty significant population are a legal sale of a business interest, but that sale is treated as an asset sale for federal income tax purposes. Commonly a Section 338H10 election, sale of a disregarded entity, a technical termination. There might be a 754 election involved, disguised sales. These are all situations where the sale is treated as an asset sale for federal income tax purposes. There are a couple other structures as well. Next slide. I think this group is probably more familiar than even the lawyers on board with the mechanics of 338H10, but I wanted to use it as an example. In 338H10, you sold stock in an S Corp, but the parties file a joint election. And just to kind of give you an example of where the department's being at least inconsistent in their approach, when you think about that 338H10 election, it's actually the gain, the sale of asset gain, is recognized on the S Corp's return and include the distributive share. It's not recognized directly by the individual. And the department basically not considering that. They also, for purposes of calculating the individual's Ohio taxable income, they're still starting with the federal income tax calculation with no change. So remember that federal income tax calculation is based on a sale of assets. So that hasn't changed, but their position again is for purposes of that gain, determining whether it's business or non-business income, they're going to say that's a legal sale of a business interest. There's a couple of, and they would typically consider that non-business income. There are a couple of exceptions. Sometimes when there's an individual that had a history of buying, selling entities, or there's an intermittent entity with that fact pattern, they may see it a little different, but overall, they're saying that's non-business income. Next slide. One of the other issues with this position is the department's had a long-standing position where they follow or start with federal taxable income, including elections. One of a very old Ohio Supreme Court case was called Deary, and it was a sale of property, and the taxpayer actually sold the property before the individual income tax went into place, but they elected under the installment sale rules to recognize it over a couple of years. And one of the years ended up being the first year of the individual income tax. And in that case, the taxpayer was saying, well, there's not a particular provision that incorporates the federal installment sale election. And the department was saying, no, by starting with federal taxable income, we adopt all elections unless we say otherwise. And the court agreed with that. But in this case, and again, 338H10 is just an example. In all of these situations, they're saying, we don't necessarily follow the election for 338H10 or 754. Again, we're going to treat it as a legal sale of business interest. Next slide. In talking to the department, it's our understanding, there have been instances where they got responses from the taxpayer, their practitioner, and they dropped the matter. We've had a few where the departments dropped the matter. I'd say those are pretty unique fact patterns. But overall, they're holding pretty fast. Overall, they would say, if you sold a business interest, that's considered non-business income. I do think you have to be careful because a lot of times in the variance notice and the assessment, they're denying all business income, not just the Schedule D gain. So you want to be careful about that. As well, there have been some with assessments with penalties, and the penalties can be abated. Next slide. I don't mean to make light of a bad situation, but this has been a good opportunity to team with accounting firms, particularly in these individual business owners. They're really trusted advisors. But having said that, in pretty much every client situation has asked the question, hey, did my accounting firm do the wrong thing? Did they file the return incorrectly? Should I have paid the tax and requested a refund? And that's always an option. Typically, and I'd say this overall, anytime you are in a situation where you're going to pay the department versus seeking a refund, usually you can get a little bit better percentages in a negotiation. As well, there's a pretty reasonable legal position in most situations we've seen that you should be claiming business income on the return. Again, there is this other option where you can file a refund within 4 years of when the return was filed. As well, a taxpayer can pay an assessment and request a refund within 4 years. You do want to be careful because once you file the refund, if you were to do that right now, they're probably going to deny. So you want to think about timing. The other thing I'd say is, at this point, the department isn't distinguishing between taxpayers with different levels of participation. And I don't know if that would change, but there might be a broader group that qualify than perhaps, Corrigan would suggest.
And hey, Deb, so for instance, you mentioned about that question that we get a lot of times from taxpayers. Did my accounting firm file the return incorrectly? I mean, in every situation I've been involved with, and I think you probably agree, is no, of course not. It's just that the department's taken a position that they've never taken in 50 years since the income tax has been in existence. Is that a fair?
That's exactly right. That's exactly right.
Okay. So we're going to move on back to Ted.
Yeah, thanks, Tom. So I'm following up on the idea, was it appropriate to claim this deduction on the returns? because we've gotten feedback from tax preparers that, well, the clients are upset that they're assessed. But the point we want to make is that the current position with respect to distinguishing business, non-business, it is a change from prior laws. So we wanted to take a couple slides here to give you a little bit of background about how we got here. So the concept of classifying income as business, non-business did not originate with the bid. In fact, it originated back in 1957 with a Uniform Act, which is the Uniform Division of Income for Tax Purposes Act. It has been around for a long time. It's really clear that the Ohio General Assembly intended to incorporate these ideas in distinguishing business income for purposes of qualifying for the bid. So to understand where we are, we go back to apportionment concepts because they are effectively incorporated in. Business income means apportionable. You take the whole item together, all the income, and then you use a formula to assign it. Allocable income, you assign it to just one state. So moving on to the next slide, the concepts here are, in order to treat all the income, no matter where it's earned in Ohio or elsewhere, as subject to tax in Ohio, there has to be a relationship that allows you to do that. That relationship, the shorthand for it, is business income. If it is business income, then you use property, payroll, and sales, or today, more often, just sales, to assign the income among the states. This approach goes back all the way to 1942 in a decision of the Supreme Court, the Butler brothers. In contrast, non-business income, which is also allocable income, is assigned to the location in which the income is earned. And importantly for our purposes, non-business intangible income is normally assigned to the domicile of the owner. So moving on, then the next question is, what normally happens in these kinds of analysis? Most often, not always, but most often, the taxing authorities are going to be pushing for it being business income. And the reason for that is that they normally don't like the idea that it goes, the income goes all to the state of domicile of the owner. So in addition to the long history in the United States, the business, non-business income approaches have been around since 1972 for income taxes. And that's the first year the tax was imposed on personal income. In the next slide, we talk about a change that was relevant to the income measure of the corporate franchise tax. So that's on essentially C corporations. But that was a change that was made back in 2003 with respect to that former tax. Why do we talk about it here? It's because after that enactment, the tax department took a very broad view of what was business income. The second idea from the historical perspective, based on some case law, is that you need to understand that, everyone understands this, the distributive share gets apportioned. It's not allocated to the owner, the partners, the member, their domicile. It's based on the operation of the business. And so the idea would be, if you're distributing that income using business formulas, why wouldn't you do the sales? And we believe that there is a relationship that should be taken into account. I have three cases that I want to talk to you about. The first one had to do with a liquidation of a business, a sale in conjunction with a liquidation. And the issue was that business income? And we had an S corporation. The assets were deemed as sold. There was a liquidation. The argument was that business or non-business income? The Supreme Court found that it was not business income. But there's two things about this that are relevant to when we're talking about sales. First of all, in that decision, the court found that the cessation of business was something completely different than the sale of an ongoing business. Secondly, the General Assembly changed the definition of business income after that case to provide specifically that the gain or loss from a partial complete liquidation is treated as business income. and they specific reference to goodwill, which is important, and Dave will talk about that more. And then they did not feel a need to change the law to deal with the sale of an ongoing business. So moving on to the Corrigan case that Deb mentioned, Corrigan was an important decision. It had to do with a different statute that's really not before us today, but the key element for our purposes was that the gain from the sale of a business by an investor was non-business income. The key element was that Mr. Corrigan did not operate the business on a day-to-day basis. He was truly, under the facts of that case, an investor. The assumption is that the result would have been different if Mr. Corrigan were an operator rather than merely an investor. In the T. Ryan Legg case, it bears out the analysis of the Corrigan situation. So this is a trust tax case. The facts are fairly complicated, and following through the tax itself is difficult. But at the end of the day, what's really important is the Supreme Court found that because the individual who had established the trust had been a founder and operator, that it could be treated as apportionable income. The Supreme Court distinguished Corrigan on the basis that in the Corrigan case, it was an investor, and in the case of T. Ryan Legg Trust, it was a founder and an insider. And that's what makes these cases different. So these are the three cases that we would be building on and figuring out how to treat these sales of the companies. And from that point, I'm going to pass it over to Dave, who's going to address directly why we think the department is wrong.
Thanks, Ted. As you point out, my slides are eloquently styled why ODT is wrong. I'll have to go back and double check, but I don't think I ever gave a presentation when I was an attorney general that was styled this way. But it is familiar material, right? As Ted points out, when I was at the AG's office, our business, non-business cases were cases where the state was arguing that the income was business income because it was in the context of a non-resident. Business income is apportionable, and the state was enforcing the income tax against non-residents trying to tax their fair share. So this is, a familiar position for me. And I'll talk a little bit more about that in a minute. But just an overview of what I'm going to talk about is a little bit about how the federal tax treatment plays into this. Let's get back to basics. Look at the business income statute, the functional and the transactional tests, the third test, the partial and complete liquidation test that Ted just gave us a history of, and then I think an important part of that is going to be goodwill. And I'll talk about that in a minute, but also the structure of the transaction. Does that matter? How does it matter? And that type of thing. So if we could move on. Or do I have control? Okay. So, as Ted said, it's really not controversial that distributive share income shown on a Schedule K-1 from an operating business that's, classified as a partnership for federal income tax purposes is business income. That's quintessentially business income. The Agley versus Tracy case says that. The department would agree with that. Where things start to go a little bit sideways is that the department says capital gain income, that's totally different. We're going to treat that differently than the distributive share income. And I'm not sure that's not a correct position because, if you look at that gain in, that gain income, how is that created? If the manager is actively involved in the day-to-day affairs of the business, this is something that should be classified as business income. We can look at a similar context in the context of C corporations. The United States Supreme Court has said that the same question, the same inquiry applies to dividends, whether dividends are business or non-business income, as applies to whether capital gains from the sale of that stock are business or non-business income. And similarly here, if the distributive share income is business income, it makes sense that the capital gain treatment should follow. Can we go to the next slide?
All right, coming up. There you go.
Okay. So, keeping in mind that the, active participation in the business is a central tenet of what is business income, let's consider the fact pattern. There's been this audit initiative that Deb talked about. So we've seen a lot of cases, and they seem to fall into a similar mold. You've got a key executive, oftentimes a founder who started or is very involved in a business, managing its day-to-day affairs, familiar business functions, operations, logistics, sales, managing employees, finances. It often runs a gamut with these types of things. And they've been very successful, and they've earned distributive share income, as they go along, which is treated as business income. But then it comes time to exit the business or sell a significant portion of it and roll over a portion of it. And that's the gain that we're dealing with. The question we're dealing with is that business income. And I think when we think about this issue, fundamentally these business managers are creating value in their company, and then that value takes many shapes and sizes, different forms, and whether it's distributive share income or income that is, reflected as the business as a going concern, as goodwill, that's fundamentally, not going to, the form of the value and realizing that value is not going to lead us to a different conclusion in the business, non-business inquiry. So that's, where I and the department may take a different view of things. But another component of these cases that I want to point out is that my second bullet point there, we're talking about Ohio residents here. These are cases where the department has initiated an enforcement mechanism against Ohio residents, meaning that they're going to pay 100% tax without the benefit of the Ohio bid. Whereas, again, as I mentioned, historically, states, including Ohio, have had issues come up with business, non-business income in the context of enforcing it against non-residents. We can go to the next slide. Like I said, let's get back to basics, look at the definition of business income, and we'll do that on the next slide. There's three tests: transactional, functional, and partial complete liquidation. The important factors that we're going to look at in these cases, I presented, a typical fact pattern, but, they do vary in various respects. One being, what exactly is the participation of the manager in the company, not just their job duties, but did they stay on after the company was sold? That tends to show that yes, they are a key integral part of the business that needs to be there because the buyer wants them there in order to run the business, right? And so that goes to show how important they are to the day-to-day activities. Did they stay on? They may have even stayed on in a permanent role on the buyer's board in an advising role. And we're also going to look at the amount of the interest sold. If this is a sale of 10% of a company, well, let me say this. If it's a sale of a majority stake in a company, this is goes to show that they're more involved in the business. This tends to show that they have control over corporate decision-making if they have, control over, a hefty portion of the amount of the interest. And then the structure of the transaction. I won't belabor this point, but I think Deb did a nice job with that. These businesses are organized in different fashions: an S corp, an LLC, taxed as a partnership. If you've got an S corp, oftentimes we're looking at a deemed asset sale, 338H10 election. Disregarded entity sales are also treated as a deemed asset sale. And we'll talk about technical terminations and how that plays in. Can we go to the next slide, please? So, I've been alluding to these three tests, and if you're an attorney in this area, you've spilled a lot of ink talking about this, and another brief or several more briefs, on this issue maybe in my future. But I'll just give you a Cliff's Notes version of these three tests. So my first bullet there is a transactional test: income including gain or loss arising from transactions, activities, and sources in the regular course of a trade or business. So the idea I would emphasize there is that the manager is actively involved in the day-to-day business, the same as with his distributive share income. Bullet 2, the functional test, and this includes income gain and loss from real property, tangible property, and intangible property if the acquisition, rental, management, disposition of the property constitute integral parts of a regular course of a trade or business. So, what I would emphasize there is that we're talking about tangible and intangible property, and the structure of the deal can come into play here. So if you have tangible property, this might be a situation where you look at the sale of a disregarded entity or a 338H10 election and say, this is a sale of business assets. That's how it's being treated. This sounds like business assets. That's quintessentially business income. And it also says intangible property there. So, likewise, whether that election's there or not, if this is an active manager selling their company, this is something that we believe should constitute business income. With the third test, this is the partial or complete liquidation language. The point I'd like to emphasize with this is that last clause there: gain or loss from the sale or other disposition of goodwill. So this is what I've been saying. Goodwill is the intrinsic business value in the company that's built up by these managers through their hard work, and they'd love to tell you about that, because they do. They're there every day. They're the life and soul of these businesses, and their efforts are creating that goodwill, and that's what the statute says. Statute says goodwill is business income. So, I think that's another point as well. As far as the structure of the transaction, Ted did a nice job talking about the interaction of Corrigan and Leg Trust. The department takes a different view. Department would say Corrigan stands for the proposition they elevate form over substance. I've been an assistant attorney general, and I would tell them that's not a good position to take. Your Honor, let's elevate form over substance is not a convincing argument. Let's look at what's going on, and I would echo what Ted had to say with let's look at the situation. Is this a situation where we have an active manager like we did in the Leg Trust case? How is the Ohio bid analysis different if there's a deemed asset sale? Well, I think in this situation, like I said, it's pretty clear you've got a sale of business assets. I think it goes to show even more. It's additional evidence that this is business income. You can look at the federal tax returns, and it'll show that there's been a sale of business assets. And Deb did a nice job talking about that, but that's business income. Technical terminations. If we're looking at whether there's a partial or complete liquidation, prior to the Tax Cut and Jobs Act, there were technical terminations if you had the sale of a partnership within, I'm forgetting the period of time, a year, a sale of more than a 50% stake in a partnership over the course of a year, and that's a little bit. We've got to be careful with that, looking at how that interacts with the Kemple case, and does that federal election take on a different flavor than a situation where you have the complete winding up of a company? How does the structure affect federal tax filings? I think that's evidence. That's the extent it's shown on the federal tax filings it's going to prove the case in court. So I've got the information release here, and I think this goes back to the point I was talking about with, I won't name names, but there are several people at the department who have told me, prior to the Ohio Business Income deduction, that all income is business income, right? And that was their position because they're enforcing against non-residents and trying to apportion income to Ohio. And this information release, which addresses the Corrigan case, seems to be, recognizing that, some can be business income. And again, they're not saying that anymore. It's a different position. Now that we're in the context of, does the bid apply to residents as opposed to, do non-residents have proportionable business income? But there's been a recognition that the sale of an intangible asset can be business income. We don't have examples from the information release, but it is there. And then with the last slide I have. Okay. The last slide. Do they want to be right on this? I mean, I don't know. I mean, I'm not going to put words in their mouth, but it seems to me that the state has an interest in arguing that non-residents have a portional business income to Ohio. The idea being that non-residents doing business in Ohio should pay their fair share of taxes. What's the effect on residents? Well, they're paying 100% of tax. And just consistent positions. That's a big part of what the state does. It shouldn't just be raising tax revenue, but it should be applying the tax laws fairly. They have a tough job doing that. But I think this is a situation where it's important to take. We're trying to promote investment in Ohio, and if we have inconsistent positions as to when we're going to deem income business or non-business income, that can be a problem. So I think that's what I have with my slides, and I'll hand it off to Tom.
Well, Dave, before we leave your slide, I mean, your point about does the department want to be right? I mean, what happens, do you think, if the bid goes away, but they win this position that they're taking right now?
Well, I think that's something they should think long and hard about, because if the bid goes away and they win this position, that case is going to be the lodestar case for non-residents saying that they shouldn't be taxed. Right. And the department will find itself in a position where, they're not getting any benefit from the argument that this type of gain is business income, and then they'll have put themselves at a serious disadvantage when it comes to taxing non-residents on their fair share of business done in Ohio.
Yeah, I mean, it's like they're changing 48 years of their position because of this one piece of legislation, which has been under attack lately and could reasonably go away. Yeah. And the bid could go away. So it'll be interesting to see how this plays out. Well, let's talk about, go through some year-end and sales planning points. I want to highlight for the practitioners and the tax planners that are participating today, and then we'll get to a couple of the questions that are on the chat as well. So I'll try and get through this pretty quickly. We're only got a few minutes left here today. We don't want to keep you too long. But the point here that we're trying to make is practitioners really need to be beware of what's going on here. They can't, it seems, because of what the department is taking as a position, simply rely on the 48 years of historical and traditional federal and Ohio income tax treatment that says whatever the treatment is for federal purposes is going to be the treatment for Ohio tax purposes. You make an election for federal, it's going to apply for state tax purposes. Now we've got more planning that's required when we look at these, and we're advising our clients on these sales transactions because we can't rely anymore on that. I mean, I think that it's the right position, by the way, don't hesitate, but there may be better ways to structure the transaction to address how the department is attacking this tradition, basically. The other aspect to think about here is if the department's position really is, it's lopsided, because the department is saying, well, we're not going to recognize for the seller a deemed asset sale and treat that as business income. So, when you make that deemed asset sale, that pushes up the inside basis. That gives the buyer a higher basis to depreciate. Well, they're not going to go after the buyer and say, well, your basis is lower because of the treatment that we gave to the seller. So they're treating the buyer differently than they're treating the seller, even from this standpoint. So it doesn't make a lot of sense. But we got to look at some alternative structures, maybe just to give our clients a little better option. What I'd like to do is kind of divide this into two big buckets. One for residents, if the owner of the company is a resident of Ohio, versus the owner being a non-resident of Ohio, because you may get different results and may have different situations to think about. I mean, if we look at this overall, I kind of want to gloss over the slide almost, because I want to say, what did we just basically say? What did Dave say? What did Ted say? And Deb, it's that if you are an Ohio resident, then the department's going to take a view that you should be taxed on the entire amount. And obviously, how do you plan around that? Don't be an Ohio resident when you make the sale. Now, I got to tell you that for the last 4 or 5 years, we have not done much in the way of residency planning for our clients. We used to do a big business telling people how to become non-residents of Ohio when the rates were much higher, but that business has almost essentially dried up for us. Now it's becoming relevant again, and so we really need to be looking at that. So some other options as we look at these Ohio residents, of course, maybe the sale should be an actual sale of assets, not a deemed asset sale. So if the buyer's looking for a step-up basis, let's really sell the assets. Now that creates some legal hurdles and issues, perhaps, depending on the nature of the assets, contracts, those sorts of things. Makes it harder, but it may be worth it when you run the numbers. Another idea might be to create an active holding company. So, for instance, if you have a parent company that owns a number of subsidiaries, well, that holding company's business would be the management of those subsidiaries. Now, I think that you need to, have some substance to that entity, and it would be also, in my experience, helpful that that entity have its own business operation, and then the department might consider that as well to be business income when you're disposing of the asset, which is the investment in the subsidiary. And then, of course, as I mentioned before, residency planning, looking at the Brightline test. Now, the key here is if you've got a client that's looking to make a sale in 2021, we still got 14 or so, 15 more days left in the year. I would advise folks to consider changing the residency this year so that you have a part year this year, and then next year that taxpayer could qualify for the Brightline test. This is a slide that goes through the Brightline test. We've got this available on our website as well, so I'm not going to go through this. But, it's a pretty generous situation and pretty easy to become a non-resident for tax purposes in Ohio. So now, again, this becomes a planning tool as we look for these sales. Now, then we turn to non-residents and ask the question, what are we going to do? What do we do there and consider? Well, I think that if it's a deemed sale of the business interest, the Department of Taxation is saying, we don't care. It's not Ohio tax. I mean, the non-residents are a much better situation. We do need to think about the situation if the sale is going to generate a loss and the non-resident has the other Ohio business income might want to offset. So we might want to think about structuring it that way. But really, right now, the Department of Tax is saying non-residents, you're good to go. We just want to tax residents. Another aspect, or just a thought, don't really have an answer because I think it really depends on the facts and circumstances. But we ought to consider whether there's an advantage to putting investment portfolios into a legal entity and then operating that legal entity as a business and thereby having that generate business income. All of a sudden, that would create business income. Of course, you got to look at what does it take to run a business and have that considered to be a business. And there's a lot of factors to consider there. So there's a lot of planning that needs to go into this to mitigate what the department's position is. We're not saying the department's right. We can still fight it. And that's really where it comes into this next issue. And again, we've had multiple cases and matters pending here. And Ted and I have been, and Dave and Deb, of course, have been talking about these issues. And we have responded by creating a client coalition. Now, the idea here is, the Department of Taxation has shown a willingness to settle these matters, as they've shown with other types of matters. I mean, the department's always been good about trying to weigh the risk of litigation and showing a willingness to settle matters. It's just that with these particular cases, we don't believe that the settlement levels that we're seeing really reflect the department's risk of litigation. So it's really a hard pill to swallow to settle many of these cases. On the other hand, litigation, it takes time, it's expensive, and it is something that you don't undertake lightly. So the response here is to form a coalition. And the idea here of the coalition is to address the economics of litigation, as well as what will happen is we have our clients who are joining the coalition are paying a flat fee that will then be used, those funds will be used to support test cases, a couple of test cases that are going to have broad enough application to give the department guidance, to give them some cover once they see that we get to the right answer with the courts. It's also going to try and support that when we've got these test cases, that we've got the best facts, the most clear facts. Because I think, as all of you know, is when you've had bad facts, that's how you get bad cases and bad decisions. So we want to make sure that we're getting the right facts before the courts. And, we want to also make sure, frankly, that we got the best attorneys litigating this case. We want attorneys, I should say, who are experienced with the Board of Tax Appeals and the Supreme Court, and also familiar with these issues and the history behind these issues. We think it's important to present the best case. And then finally, another goal of the coalition is to simply get to the right answer much more quickly by supporting those test cases and those key cases. What I would like to do is ask Ted. Ted, is there something you want to comment about the coalition that our firms are working together on?
Yeah, thanks, Tom. A question came in. Isn't the way to deal with this is to look at the federal income tax treatment? And we agree that that's a really solid position. But there are other parts to this litigation involving the participation of the sellers in the business and the relationship of goodwill. And especially if you get up to the Supreme Court who are non-tax people, there's a complete story to be told here. And I think that the coalition allows us to really put together the very best case to really get a successful result. And it's, as Tom said, it can be expensive. So this is a way to get the benefit of having other people help you in making that best case.
Now, of course, the challenge here is some folks might say, well, we'll just let that coalition move forward. Well, the coalition's only going to move forward if we reach a certain amount of influence and participation, I should say. And so that's going to be very important. If this is something that, you're looking at your client situations and you think that this makes some sense, of course, feel free, or if you want to ask any questions, feel free to contact Ted or our firm as well. The fact of the matter is Ted and I are competitors, but we feel so strongly about this that we need to get to the right answer. We need to get to it economically, that we've joined forces here. We've worked together on other issues together, and we have a lot of respect for each other. So we really invite other folks to also consider contacting us to ask us about how this works. I do want to, there was another question I want to throw out here to Deb, because I know, Deb, you've dealt with this, is the question from Melissa is interest income on an installment note of a business interest considered business income?
And just to make sure we're clear, because I think this issue can come into play two different ways. One is if you sold the business and it was an installment sale, and as part of the sale contract, there's an interest component. I think the department would say that's not business income, but I think there's a pretty good argument that it's part of the sale. There's also an aspect, if you have a straight sale, but under the federal installment sale rules, they recharacterize part of the gain as interest income. I know the department considers that to be non-business income, but you have the same issue of, well, you're following federal or not following federal. So if we didn't follow federal, is it still just part of the gain? And then would it qualify as business income? So just to be clear, I think the department would say it's non-business income, but I think there's a good argument that it's business income.
Yeah, it depends on facts and circumstances. So it's something to look at and consider. Peter had a question about CPE credit. Unfortunately, we're not able to grant CPE credit. And Renee asked about whether or not the slides would be available for download. This presentation will be available on our YouTube channel. I encourage you to subscribe to the YouTube channel. We have other programs coming up I do want to thank the panelists, Greg, Dave, Ted, Deb, for helping to present today. I encourage you all to kind of look at these issues, and before we get too close to year end, really think about how these might impact your clients moving forward. There are some options here to address it, and so we'd love to work with you guys on that and working with your clients. Thank you for joining us today. Enjoy the rest of this snowy day. Please stay healthy and have a great holiday, and let's welcome in a new year. 2021 will be a much better year. Take care, everybody.